Good evening, my fellow traders. Good evening. Welcome to this evening's presentation. Thank you for joining me. My name is Adam from Trade with Precision, and yes, welcome. So tonight's topic is Forex, winners and losers in the new economic paradigm. First of all, can I please do a sound check? Just make sure you can hear me. If you can, and the sound is good. I've got green lights across the board. So on my side, everything looks good. And the sound should be loud and clear, should be good. So without further ado, we can sort of kick off. I would love for this to be as interactive as possible. Let me just see that I am on the right ones. There we go. There we go. Cool. Yeah, I'd love for this to be as interactive as possible. So please feel free to ask questions. If there's something in particular, if there's a particular currency pair or something you want me to have a look at, just let me know and I'll definitely make the time to include it if I've got it on the platform. And what else? For those of you who don't know me, I am based in the city of London. I am a trend-based trader. I trade my own capital and I trade client capital as well. That's not a solicitation. I'm just giving you some background. And yeah, I trade all the markets. I'm a day trader at the moment. I used to do a lot of swing trading the daily timeframes, and not so much intraday trading, but whereas these days, actually most of my income comes from trading the 15 minutes up to the 1 hour timeframes. So on the agenda for this evening, we're going to do a live chart analysis. Thanks, Leon. I really appreciate that. I do appreciate that feedback. Thank you. Yeah, what was I going to say here? Live chart analysis of all the major currency pairs. We'll have a look at that. We'll try and get a sense of the bigger picture. All right, that's obviously, I think, important here to get a sense of just context, analysis in the bigger picture across multiple time frames, identifying potential trades that may be setting up, and building a watch list of favorable pairs, Forex pairs. Okay, so it's interesting. I'm gonna just quickly bring up WordPad because I want to give you guys a sense of something first. But okay, so there's a couple of things I want to talk about here. I need to talk about first of all, I want to talk about the US dollar. We'll talk a little bit about inflation and how that's going to play its part. And rate hikes. Okay. 3, we want to include so then we'll go through the different pairs. We'll create a watch list. And I think what's important in that is which charts and why. All right, so why would a chart be considered worth trading? And hopefully what I would like for you to have at the end of the hour is a clearer understanding of why a trader would choose a particular chart, to the point where it makes sense to you. Trading should make sense. Okay, if it's not making sense to you, then whoever's teaching you or talking about stuff is kind of maybe not the right person for you. Trading should make sense. It is a rational, evidence-based activity, guys. There was something else I wanted to add to this, but okay, so let's get started here. At the moment, we have inflation, which is quite bad. All right, now we need to remember that it was COVID okay, so well, actually what we really need to do, if I just go and give it some context here, is I'm going to go to the S&P. That's fine. We'll start with this one here. So please understand that inflation always happens at the end of every big run. So we're on a monthly chart now, so every time there's a bit of a bear market or big correction, inflation is always there. It's always there, because usually what happens is, as the market is having a really, really good time, people eventually start earning a bit more, maybe making a bit more money and spending a bit more, and then inflation sort of kicks in. And then usually at some point, the central banks their main go-to tool for managing that is to increase rate hikes. So when they want to stimulate an economy, they drop interest rates, which encourages lending, and so people borrow money and they spend it and it gets money into the system. And when they want to cool things down, they start raising interest rates, which stops people borrowing, and they start cutting down on costs. and it creates it curbs inflation. What's changed in the last since 2007 is that the banks have left it too late when they should be kind of kicking in probably about here, as you know, basically the market's already pretty stable. They should sort of be doing it as we go. They don't want to do it because the kind of the going is so good that they really only do it when the market starts to kind of get too hot. And so they should be cooling it off. In fact, they should have done it sort of even here. They should have started doing it. But anyway, and then what would happen is but it's always like they're always locking the barn door after the horse is bolted kind of scenario. So COVID created part of that problem, because although the market was doing well, there was a lot of stimulus cash, which came out as a result of helping the world from different banks around the world, helping central banks and governments, stimulus cash to help businesses survive and people survive going through COVID, through the lockdowns. And a lot of that stimulus cash by the big companies that can borrow it will put it into the stock market because they can earn a greater interest rate. They can borrow it, put it into the stock market and earn better returns off that. And they don't even have to employ any more people to do it. The downside with that is that also people started looking for better jobs and negotiating better salaries. And so coming out of it in this period here, a lot of people have been making more and spending more, decided, okay, they can go back to work, it's safe, they can spend a bit of money on their house because they've been hanging around their house for such a long time, they realize they want to spend a bit and fix it up. And so that is a core brick or puzzle piece in the picture that has created where a big chunk of our inflation has come from, is from COVID. The other one, and it's a major factor as well, is Russia invading Ukraine, and both Russia and Ukraine provide a vast number of different things, commodities to the rest of the world, from energy to food, sunflower oil, wheat, all these things come out of Ukraine, and so that there's kind of been this, it's had a global impact, almost literally on the price of bread. Depends on which country you're in. But those two things have been kind of, I would say, 70% of the drivers behind inflation. If we didn't, unfortunately, we wouldn't necessarily have got some of the boom that we've got here without COVID, without some of the stimulus cash that went into it. We would have got some growth, yes, we would have, but it wouldn't necessarily have been as much as it has. Anyway, and so what we're seeing here is a much needed correction. So let's just say if we could look back and I had 100 years worth of this, you'd see this all the time. You'd see that all the time, and you'd always have these corrections because price always has to go away from the moving averages and come back. And so that's the basis for a lot of this is going to be transferable, by the way, to the other pictures. So to come back to this, inflation and rate hikes, that's kind of how we come to be where we are. The US is the biggest currency in the world. It's used in 95% of all transactions. It's the biggest economy in the world. It's just huge. Taking China out of the mix for now, it's bigger than the next 8 countries combined. So Japan and the UK and Europe, put them all together, it's bigger than all of those. So after World War II, the US owned 95% of the world's wealth. Okay, that's the scale. So sometimes I live in the UK, and sometimes, before I heard that, I was, not really under the impression that the US was necessarily that much bigger, but it's titanic in comparison to a lot of other countries. So the dollar, what also happens in situations like this is, generally speaking, when the market drops, it's good for the dollar, but not only that, when we get rate hikes with currencies, and so bringing it back to currency markets, when central banks raise the interest rates for currencies, that tends to strengthen the currency. And so what we've seen, if we go and have a look at some of these, so let's go up here and let's go look at it from a weekly perspective. We've had a much stronger US dollar. Now there's a little bit of a bigger picture to it. If we go look at the monthly for euro dollar, it has been largely range bound. Many currencies have been range bound from between, say, 2014, 2015, around that time. So to just kind of illustrate a point, let's just take, what was it? Was it pound Swissy? There was something I wanted to have a look at on a monthly basis. Again, we've got range bound from that same period. It's strange, but there you have it. If we go to pound CAD on a monthly basis, range bound, same period. Okay, just stuck in that range. And there's just so many of them. So many that have been like that. let's see if I can find another one, like or Euro Yen or something. So Euro Yen was kind of here up until recently. It was stuck within that range, and it's just started to break out now. So many of these charts, like 80% of the charts, have been stuck in a range from mid 2014 to 2015, and it's very possible that that was, I don't know for sure, and actually no one talks about it, but I suspect that that was economies just trying to stay within a range on their currencies, just trying to keep the economy stable. They're trying to keep because remember, they've got the internal economy and then of course the external trade with the rest of the world, and both are important. Some countries are literally export countries like Japan and stuff, where a lot of their economy depends on their relationships with, say, the US is one of the biggest trading partners. And so the point is, it's possible that they were all either following their own lead or just that's how it happened. The markets just tended to range. So if we come back to the euro, come back to the euro dollar, this move down made sense as part of the move from the top of the range down towards the bottom, but it continued through that. So continued to push through this through the market, and so it's continued to go on with that, and that becomes more a picture of the stronger dollar. So certainly I would say the stronger dollar kicking in or really getting sort of juiced up is probably from about here, whereas this initial part was probably just part of the normal ping-ponging around. But definitely we've started to see a lot of that, and it's much more obvious as well when you bring in some of the other pairs. So if you kind of swap this out for cable and have a look at cable, you can see that also a lot of strength there as well with the US dollar. If we go and have a look at, say, Aussie dollar, let's see, not as bad. So Aussie dollar's managed to kind of hold its ground. Kiwi dollar as well. Let's have a look at that. Kiwi dollar and Aussie dollar, very similar, generally speaking. They're usually sort of cousins of each other in terms of how their behavior is in the market. So this is from a economic perspective, or from a from an economic perspective, this is where we talk about kind of going into a new era in terms of currencies. And it's, let me kind of explain that so that it makes sense. Because we've been in this range for a while, and actually I was kind of, to give you some sense of it, where was I? So I sort of started learning how to trade. I would have been somewhere here. Well, not the first time I opened a demo account to try and learn, but when I first kind of committed, this is where I sort of first was like, oh, okay, let's get into it. This was where I was actually got training and started to paid for some education to do a whole variety of things. So actually, this was a big chunk of my kind of first few years, the euro generally climbing, then generally dropping, then going up. This was an interesting period as well, just that dollar kicked through as well, knocked everything kind of sideways. And again, you can see that level of support becoming resistance. And then sort of since that period, October 2014, we've been roughly in this area. And now what's significant, what is very significant, is that we've broken out of this range. We've started to head down. And generally speaking, we would probably head down to the next level, which is probably here. But along the way to get to this level is parity. Now, parity is more of a psychological thing than anything else. Parity is when one currency is exactly equal to another. So when one US dollar can be exchanged for 1 euro. Okay, and generally, as you could tell, going back to 2000, basically almost the whole of this century, the euro has been stronger than the US dollar. And to make it even weirder, the currency markets prior to this point, so over here, was not even available to the public. We couldn't even trade it. It was only kind of mid-97, where from this point we are able to start trading. Retail traders such as ourselves, such as you and me, were able to start trading the currency markets. Prior to that, it was just interbanks and big institutions. So I find that fascinating because that's the difference. Look, just from this period to this period was, it was a little bit all over the place. That's probably when it started to move below that number and then get back over it, because now retail traders are coming in and I don't know, the markets are expanding. And then actually from that point onwards, it's been about parity for 20 something years. So from an economic perspective, it's not necessarily the end of the world. I've been around on this planet, I can't believe I'm going to say this, for more than 40 years. And, you know, some things change and some things stay the same. This doesn't necessarily impact us. I would urge people to keep in mind that inflation, which can often lead to a recession, for example, everything, is usually normal. In other words, it happens at the end of we had it at 2007 to 2009. We had it, they've had it in the past. Okay, they had it after the dot-com bubble. So it happens every 10 to 15 years, give or take. There's a little bit of a concern now. So a couple of people, Michael Burry, if you've seen The Big Short, Michael Burry's the character was portrayed by Christian Bale, and Ray Dalio. Ray Dalio is phenomenal as well. Find him on YouTube. He owns, he's the founder of Bridgewater Associates. He manages a global fund, but he's very good as well, does a lot of research. But there's other investors who talk about this, but these two guys are generally, their concern is that you get what's called sort of earnings compression, and then there's another compression. I've just blanked on what it is coming after that. So I know it's the first wave of the correction in the market is really just kind of the effect of raising interest rates, and it's a pretty gentle one in comparison to what can happen after that. That if the markets stay in this stage too long, then companies will their earnings will be impacted, and then they'll start cutting people and cutting jobs and stuff, and then people stop spending, which will lead to shops earning and businesses earning less, which is like a doom gloom sort of cycle. It's a dark cycle. So that's kind of to bring you up to that. In my experience, ladies and gentlemen, it always pays to be optimistic when it comes to the markets. We're not saying that things can't get darker. I'm saying historically things usually get better long before people have accepted they get better. For example, it's at this period when the markets were at their most pessimistic, and if we do end up going back up from here, it'll be at this period the markets were at their most pessimistic. So if you're hearing nothing but doom and gloom, that is not a reliable indicator that of what the state of the markets are. It's really important to nail that point down. If everywhere you look and listen and hear in social media and the news, everything is like, oh no, the sky is falling, and the market starts climbing, that is normal. That is normal. And it's usually around about sort of here, the markets will start to say, oh no, maybe it's not so bad anymore. So don't trust what you necessarily hear in the media too much. Take it on board, digest it, and then see if it's matching what the markets are doing. A lot of people always think that the markets have to capitulate or cave in, like the markets are not paying attention to what the news is. Now, most of the time, that's not really the case. The markets are actually the reality of what's going on, and there's a lag. There's a lag between the markets on the drop down, and then the news comes out and says, okay, this is what's going on. And when we start climbing, there'll be a lag. Again, it'll start climbing up, and then people say, okay, it's recovering, and this is why it's recovering. So there's a lag between the media, so you have to understand that. So it's better for you to kind of pay attention, for the most part, to what the charts are telling you. Okay, so I've given you a rundown of the dollar, its place and everything, inflation and rate hikes, and then we can get into currencies as well. Okay, so what I want to do here is quickly give you a sense of why, first of all, we are as traders, because I kept starting to say the sentence, economically, it might seem quite dire and so on and so forth. Maybe it's not. Maybe it's not. You've got a good salary at the moment. Your living costs are low. You're keeping your costs down, and it shouldn't change for the next few years. So you should be fine. So in fact, you might actually ride this out. If this is the bottom, we might ride it out fine. The UK is not as exposed as the US, and the US at the same time will weather it. Even if it's worse for them, they actually are inherently they've got the capabilities to weather it. So we should not have it should not be as negative for us, but also we're not necessarily as bulletproof because our economy is not necessarily as big. Let's go and have a look at that, for example. Let's go and throw in the, look at these ones here, the UK, the FTSE. So I'm trying to give you some bigger picture bearings so that you understand that the dollar is prevalent in not just that there's a connection. I want you to see the connection between the index markets, the US, which is a big cog which impacts all the other countries around the world, and commodities such as gold and oil. If you've got a strong dollar, you will see gold dropping. It doesn't mean gold isn't popular. People could still be buying gold, but the dollar is stronger than gold, and gold is priced in US dollars. If the dollar is strong, you will see crude oil will drop as well. So there's a connection. If you have and sometimes the dollar isn't really going anywhere. So sometimes it's just kind of, for a few months at a time, the dollar isn't going anywhere, but then sometimes it's weakening it's actively weakening. And right now it's actively strengthening, which is why you can see an immediate visual correlation between crude oil, gold, and the markets, them coming down. There's a high correlation of that. Once inflation calms down and the dollar isn't necessarily, there isn't any kind of panic or anything like that, we'll probably then find that the currency everything starts to uncouple. But I wanted you to see the connection between the US indices, the other markets, currencies, and commodities. That they're not always connected, but they are at the moment. Strong dollar has been moving everything. Right, now that I've done that, let's go back and talk about what we're going to do. How would we would select what we're looking for. So first of all, we can break any chart and any currency and any time frame into one of two conditions. Currently, it is either not trending, doesn't matter what time frame we look at, or it is trending. So it's either trending up or it's trending down. So statistically, and there's three different ways we can trade the market, okay? So the first way would be if it's range bound, we could sort of try and box that range and sell at the top with our stop loss up here and try to target the bottom. Okay, that is the second best way to trade, in my opinion. Then the third, which is the worst way in my opinion, and a lot of very, I guess, respected analysts, not traders per se, but a lot of analysts always think that reversion to the mean, meaning that the market always kind of come back to its average, so go away and then come back, and that reversion to the mean is a very safe or sensible way to trade. I don't think so. I really don't think so. I think it's an inverted reward to risk, meaning it's very highly unpredictable. It always is against the trend, always against the flow. And it's an inverted reward to risk, meaning you risk 1% to earn less than 1%, and the probability is always against you. And the final way, number one, in my opinion, is trading with the trend. Okay, so once we find a trend, we try to find a nice, elegant entry anywhere from when the market starts to pull back to when it takes off, ideally before it breaks to a new high, and we try to join that trend and we try to ride it as much as we can. It's very difficult to get even 95% of that move. If you can get 50 to 80% of a move, you are doing absolutely fine. You're a champion. You're an Olympic athlete. Okay, so there's a couple of things we have to get framed correctly so that we don't have misconceptions and then do things that don't make sense, that don't work in our favor. So basically, the goal would be to try to, essentially, it makes your life a lot easier if you just eliminate charts that are going sideways. Just forget about, don't focus on those charts, and instead try to create a watch list, which is made up of predominantly trending currency pairs. And then your only target, because now you know what to trade, and you know which direction to go. Let me repeat that. Once you've eliminated everything else and you only have trending charts, and if there aren't any trending charts, you don't trade. And if there are, you know what you need to trade and in which direction. What's left is where do you get in and where do you get out. If it goes in your favor, where do you put your stop loss? So a couple of very quick concepts here, because all of this is to try to give you the basis for a strategy, which is not part of the slide deck today, but it's worth it to know it. Generally speaking, we have these swing lows and swing highs. So the turning points at the top are swing highs, swing lows at the bottom, and we call those market structures. We call them market structures because, the market is made up of price levels. So the market tends to go to one price, and then if it can break through, it tends to go to the next major price level. And if it can't get that, then it tends to go back down to the next price level. So major price points are like magnets that eventually will draw price to it. What we try to do as traders is when it breaks through to a level, we then try to capture pieces of it as it goes up to the next level. We try to capture between the levels. When it gets to the level, we stay out. Then we're like, we shouldn't be in any trades because we don't know which way it's going to go. Once it breaks to the level, we keep going, or if it reverses, we start trading in the other direction. And so these market structures are a really good place for us to put our stop losses behind, okay? Because what happens is when the market's going up, then it tries to come down, because some of the buyers here have taken profits, some sellers are trying to come in. Look, in any market, even when the property prices are climbing, there's someone trying to buy and someone trying to sell. When the property prices are dropping, there's someone trying to buy and someone trying to sell. And so remember that depending on which way the tide is going, one side is generally winning. So even though the tide in this case could be going up, there could be people trying to get out of a position and selling. So they'll be selling as soon as the market drops down in the hope that they can lose less or just sell at a better price. Hopefully that makes sense to you. So every time that it comes down, what happens is buyers will come in and prop it up. Not only will they hold it up, but if they're really good, they will get the market to go up and break and create a new high. So there's a couple of different components to a trend. There's a pullback, and then there's a period where we get the swing low, which is the buyers coming in and propping it up. They then push it, and they have to break above the old high, and they create a new high, which is another characteristic of a trend, is creating a new high. So I wanted you to know this because I think it's also important for you to understand that for trend traders, and these are all trend traders in the world will fit into one of these categories. There are trend traders who will try to identify the turning point on the pullback. So they're waiting for the pullback, and for them, they're trying to identify the sweet spot. If they can actually get anywhere here, that is acceptable. Anywhere in that area is acceptable. To try to join the trend. So remember that it's not a single move that makes a trend, it's a collection of moves. In other words, a trend is a series of events that are communicating a single message or direction to us. Okay, so they're waves, and which way are the waves going? To the upside. So when we join a trend at the bottom, we're counting on the fact that the series of waves is going up, and therefore that's what's going to take us with it. Okay, so in this case, that's really what they would try to do, is the sweet spot. That's their ideal entry. However, you should know that there are lots of other professional successful traders who only enter on the break of a new high, or the break of an old high creating a new high. That's there. So if what I want you to think about is that the very last legitimate place that a professional would ever consider entering is on the break of an old high going into a new high. So let's call it a break of a new high. And the sweet spot would be somewhere down here in the middle. So what does that mean? It means that technically anywhere along here is acceptable. I mean, on a grading of out of 10, that would be 10 out of 10. And this would be a 6 out of 10, I think, according to, but anywhere along there would be better. The beauty of if you can master trading in on the pullbacks is that by the time price gets up here, if it fails to break out, you've already got some profit. But people like the break of a new high because they see that as a valid entrance. And also you could argue likewise that as soon as the market starts to retrace, you could start looking for entries along here. So that, in other words, you could argue that anywhere in this area is an acceptable entry. The sweet spot is here, the last resort is here. Does that make sense, guys? Is what I'm saying making sense to you? Okay. But conversely, the worst place for us to get in, which our untrained nature always tells us to do, is to get in this area. We always get in the second half of the, thank you guys, in the second half of the move. There's a reason for that. We are nervous, and we're also feeling a lot of social pressure. A lot of people talking about all-time highs in the stock market and blah 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 blah. And so we want evidence. And so to be fair, we wait until we see crystal clear evidence. And usually we hesitate here and here and here, and then finally we jump in. And that behavior is so predictable in humans and animals. It's so predictable that we will wait until the last minute because we just hesitate, and then we're frozen, and then we jump and it's too late. It's very predictable. And so we have to retrain ourselves, getting in on the second half. So in other words, that's why I say the second we entered past the old high, that's when you're now entering. That's the last point you can get in. Anytime after that, is where now the risk of a pullback is increasing, and obviously, or a market failure, or a top, but also, and the risk is just higher. So anywhere below that is the best side of risk, anywhere above that is the worst side of risk. And so you retrain yourself. It doesn't take long. In fact, that's probably one of the first things that is corrected when there's a lot of things you have to fix when you learn to trade, but one of the very first things to do is to do it. So one of the tricks that we use, which I'm going to show you here, is we have moving averages. And when we have a really, really nice trend, the moving averages and price will always interact well with each other. So we're going to use a 10 and a 20 as our moving averages. Nothing complicated, simple or exponential is up to you. And those moving averages together, that area in and around the 10 and 20 moving averages, is going to represent the zone. This is going to be like the train station. Price is going to come back to it. So we can only get on the train when it's in the zone. If it's left, we've got to let it go if we're not on it. And if it has already left, it's too late. We just shouldn't chase after it. Okay, so that gives us a great place to identify entries. Just to clarify a few other things. The ultimate goal of trading is to have as little as possible on the screen. As little as possible would mean candlesticks and support resistance levels. Let me just go and show you this on an actual chart. So let's go through and just look at something like this. Let's just get rid of all the objects. Oh, I don't have my clean objects thing. Okay. Let's just do this. Just go. Okay, fine. So, and then I'm just going to change my templates to default. Okay, which is going to be. Let's just get rid of that stuff. Delete. 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 The clearest, cleanest thing, and don't be intimidated by it, is just standard candlesticks and support resistance levels. So the magic, and I'm going to give you a very powerful, very quick introduction to it, is what we really want to do is generally observe what the candlesticks do when they reach a major price level. Drawing and identifying price levels is something that you will have to practice and do for years. You will get good at it pretty quickly, but you keep refining it over time. Because the real thing is kind of where does a line really matter? Where should I do it? The point is that how price reacts at that level tells us a lot. Here we have price coming down, goes up and comes down. This second candle is a massive clue as to what the next thing is going to be. It's a double bottom, okay? But the second candle is a bullish engulfing candle. It's huge. That is almost certainly an indication the market's going to go up. It's an indication the market's going to go up. The confirmation is when you break this high. So when you go from a downtrend to an uptrend, you have to break a high as well, and you have to produce a higher low higher. So you have to go from a low to a high to a higher low to a higher high, and you have to break a previous high. Like all of those are things that happen that show the market is now investigating higher prices instead of lower prices. And so that's when you get it. So some people will get in on the high of this one. So some master traders with confidence, balls of steel, what's it called, testicular fortitude, will get in here. That'll be their entry and their stop loss. Because in 90 out of 100 situations, this will go on and be profitable. And in the other 10, it'll fail. But most of the time, it'll be right. The next set of traders will get in on the break above that high of that candle there. Boom. So as it breaks above, that to them is a confirmation that this signal is following through, and they'd get in. And the remaining traders would get in on this candle here, because it's a break and a retest. And again, when price is going to reject this and go away, you get a bullish candle, a nice green candle. That usually means you're going to get a swing low. And at the top, if price is going to come and if it's ultimately going to reject it, you would hope to see a strong rejection candle, and the next candle breaks the low. So here we got that. We got that pull through. We got a bullish candle here, a break, entry above there, stop loss below the low, which is also protected by this. These are very simple core concepts, guys. Trading well is not about complexity. It's about doing simple things really well and really consistently. So again, everything I'm doing here kind of makes sense, because then we start to see high lows, high highs. We start to buy. Look, most traders would have got caught up by this. It's an engulfing bullish candle. I mean, that's just ridiculous. but it could have ended up being, for example, they might have had price get in here, put the entry there, stop loss there, price would have taken them up, then stopped them out, and then carried on up. They weren't really wrong about the direction. Sometimes a big candle does kick you out. Okay, so the thing that I also want you to remember, and I know you want to have a look at the charts, and we will get through those, because we don't have to go through all the charts, because we're going to go yes, no, whether it's tradable. What I wanted to say to you was trending charts behave more predictably, guys, than sideways charts. So what I mean by that is this is an unusual occurrence within a trend, because this is mostly sensible stuff. But if we were going sideways like this, then you can get wacky doodle stuff all the time, because these conditions actually, professional traders exit those conditions. So the only people that are left trading this are, I don't know, quants and robots and just normal day-to-day transactions, because remember, this is an actual market. So people in Europe and Japan are exchanging money. So there's an underlying market. It's not just traders. There's actual tourists exchanging money, people sending money abroad, businesses ordering goods. There's an actual market on top of that. And when you buy something off Amazon, you don't go, oh, let me go check the exchange rate. Most people don't. They just go, oh, I can afford it, and they buy it. But that feeds into the exchange rate, guys. So trending markets generally are more calm and sensible and well-behaved most of the time, whereas these ones are erratic. So weird behavior here makes sense because the market doesn't really have anyone in control. And when we talk about, one side's controlling it, it's never one institution or something. It's usually there's a bit of a flow, so then some people start getting in, and then other people get in, and other people get in, and it snowballs. All right, so I also want to dispel the rumors that you're trading against someone else and it's a zero-sum game. There's nothing in the world stopping you from buying or selling at any time, which means you can pick whichever direction you want. So, you might pick the same direction as the people you're trading against. So it doesn't really make sense when they say that. It's ridiculous. And actually, generally, when you're trading with the trend, this is also a massive reason to do it, is because you're trading with the big money. You're trading with the big money. Okay, so I have principally given you some sort of solid basics here. So the smallest amount we can trade with on our screen is price action and support resistance levels. When we add the moving averages on top, we then actually, I'm using those moving averages, guys, to frame price action, to find my entry place, to find that train station. That's what the moving averages are there for. So they just they help organize the information a bit better. And the only reason we use MACD and RSI here is because these two indicators together act as a double confirmation. Is the trend strong or is it getting weak? Okay. If you want me to explain that, you need to let me know. If you want me to explain why I mean that, or how we use them to do that, you need to ask me, because I kind of am a bit worried at the time. So here's what I'm going to do. We're going to go and I'm going to close some of these because I've got a lot of these things open. Okay, so I'm going to add one more, and now I'm going to show you, we're going to go through this and scan the markets together. So I'm going to look at the daily chart. And one more thing that I want to give you a clue here, because some people, actually, this is really important. Again, I know you might feel like I'm avoiding doing the core thing, but actually this is really important. Let's do this very quickly, guys, to talk about whether you should be a day trader or end of day trader, to give you this information. I'm at my desk on average about 6 o'clock in the morning, 6 to 7, somewhere around there. I'm usually finished my first batch of looking for trade setups by 9 a.m. and then I might come back again from about 12 and find most of my trades by about 2 or 3, and I'm definitely done by 6 usually. Okay, this is for day trading. So that means that I'm usually in this session here where we've got a nice overlap and increased volatility because of the Asia session overlapping with the early part of London. Then the market can sometimes go into a bit of a coma until the US comes online, and then I'm looking for my next batch of trades where the US overlaps with the UK. So there's usually a lot of really good stuff happening during this period. Okay, and then by 6 o'clock it's pretty much done. So I would normally just like at that time wrap it up. But if you want to keep it to your bare minimum and you get all your trades in the morning, you have 2 or 3 winning trades in the morning, you can just relax. You don't even have to come back for the rest of the day. If you have, because sometimes your trade setups, you're waiting for the price to pull back into the train zone, into the train station, and it only happens at 1. So you don't get to take your trades in the morning. You have to wait until later on in the afternoon. That happens. Okay, so, and then the only other thing that's left behind is that if I'm an end of day trader, meaning that I'm only going to trade the daily charts or higher, then I would be at 10:15 after the 10 o'clock close. So at 10 o'clock, in case you don't know this, all the brokerages around the world, it all happens on computers. They close and reopen all the trades in a few seconds. And what that does is that closes the daily candle. So they know, okay, where was the close and the open of the daily candle for the markets? And then you get your daily candle. And so then and the problem is that at 10 o'clock, the spreads go wild. They can't help it because they've got to close and reopen the trades. And so it causes a lot of volatility. Most brokers, really good brokers, will try to protect you from that. They'll cap the spreads or they'll do something like that. Some brokers won't. And I think reputable brokers are not really the problem. So I wait until about 10:15. By that time, all the trades have opened and reclosed. The daily candle's done. The spreads have calmed down again. And then I'll place my orders around the daily candle. Okay, and the thing is that if you're an early riser or you're up at 3 in the morning, you could do it then. But I would not do it later than 3 a.m. I wouldn't do it after that. So anywhere between 10:15 and 3 a.m. you can place your end of day trades if you're a night owl. But so that gives you a sense of kind of whether if you want to day trade, what time you have, where you should be doing, or what time you should be doing it, and so on. So the next thing is that if we were looking at the daily chart, again, I'd be looking for trades to come back into the train station. That one just jumped out at me. That is pretty much a no-brainer. It's not just that it's there, it's also a break and a retest of support resistance. So the support resistance level is when you've got at least 2 touches. So if the market is coming down in space and then pulls back, that doesn't mean anything. But if it comes back down and then has the same reaction within a few pips of the first one, you can tell that that level must be now significant to the market. So here we had price pullback. It was really this one that kind of created a bit of that reaction there. So we had, well, which is actually a little bit higher, it's there. And then we saw that bounce again, and then another bit of a bounce, then a breakthrough, then a retest. And we saw that. So it's really that low there and that low. So that was pretty cool. We had a move down, we had a pullback, and then again, there was a bit of a setup here that didn't trigger, but interesting enough, these did trigger, and then they went down. So if you had entered off those, you would have got 1.5 to 1 if you were doing that as a swing trade. This setup here did not trigger, so no trade there. That one didn't trigger, and now it's broken above this high. So now we're not in that downtrend anymore. And again, here we actually break, we come back, and there's some potential there for trades there. Coming back here, you might have been triggered in here, so you might have been stopped out here. So that might have been a losing trade. And that's going. The beauty of end of day trading is that when you look at the chart, there's either a setup or there isn't. It's either in the moving averages, it's either trending, and if it's pullback, there's either a nice bearish candle or a nice bullish candle in the buy zone. And if there isn't, there's a trade setup. So look at dollar yen. Look how nice this was. So really nice, straightforward setups. Price pulls back in here and takes off. Even here, it was pretty good. Even here, it went up and then stopped out. So that was the end of the run there. And then you might have taken that one, but then it's like there's definitely creating fresh lows here. So that's not a good thing. And then again, price kind of pulls back. There's a bullish candle, which is too big, takes off. There's another one. That's a good setup. That's a good setup. That one, arguably, this one then becomes a losing trade. So out of these, you get like 80% winners, 70% winners, and 30% losers, which is perfectly on brand. Okay, and again, this is really interesting. You get a beautiful level of, here's your resistance there, and it becomes support for this one, and breakthrough, and there's your beautiful rejection candle. So you come back, test it, there's your entry, and you'll sell, and you go down. Yes, so everything I am telling you now is to be used on the lower time frame. The reason I'm telling you this is because I was going to go to the lower time frames, and then I thought someone would say, can you use this on the daily? So I just started on the daily. So the point is, I wanted you to, so the beauty of end of day trading is there's just either a setup or there isn't. There isn't really a setup here at the moment. So we move on. So you can go through the charts at a speed, something like this. Nothing there, nothing there, nothing there, maybe something here. So I wanted to show you that because I just wanted to give you the speed at which you can kind of work through the market. So let's do it differently. Let's go down to the 4 hour. So for day trading, what you're going to want is to get a sense of, here it's trending. You want to, oh, this was the last thing I wanted to show you. If the last like 6 to 10 candles are all like this. There's nothing to trade on that, because if you go down to the lower time frame, all you have is this. That's how you get that look. So in other words, just move on. If your last 6 to 10 candles look like this, move on. There isn't anything on the lower time frame. So let me show you this. We go to euro dollar, look at it on the daily. That's it. Look at that. You've got like 10 candles at least, if not more, sideways, completely stuck within that range. So what does that mean? It means that if I had been trying to trade it intraday, it was shockingly bad. It would just go up and down and up and down and then down and up and up. It's not ideal. It's not what we want to do. So what I really want is to find the daily where the daily is looking, where alternatively, I want to see the daily with like 3 marching soldiers, up or down. If I see that as a minimum requirement, the market's moving, and that's usually a good sign. So nothing on euro dollar at the moment. It's range bound. It's range bound, and I'm doing this because we'll do another webinar next week and everything. Right now, the market is the dollar is trying to decide if it needs to strengthen again or not. If it breaks above here, because this is the range, it's battling it out. If it breaks above here, it's likely to then go up to about here, at least. If it breaks below here, it's likely to go back down to parity again. It's not tradable now. So that gives you a sense of direction and what to look for. So on the 4 hour, you just keep an eye on it. You just need to break below or break up, and it's battling that. We look at sterling. Sterling is generally stronger. It's generally climbing to the upside. If you look at it on the daily, it's trying to climb up. So again, if we finish and tomorrow we break above here and we start breaking above there, we're likely to see that climb. If we look at Aussie dollar, that is actually a bullish candle. We've come up here. Look at, there's quite a few things here. So this is why I want you to pay attention. It's not very clear, but let me help explain. You can see there's a bit of a high here and a little bit of a high above these candles. So price came down, came up here, came down, and came up and down here. So I'm just drawing those levels in because I want you to see them, because we've broken them. We've broken back up above them. We didn't break above here. That's okay. We broke above these. There's even another high here. So we've actually broken on quite a few of these. We've broken to the upside. This could very well be our very first pullback before carrying on up to the upside. And that is a very nice bullish candle. So this is what I need to see tomorrow. A break above the high and then target possibly the top here. If we continue, then we can obviously get all the way back up to there. So how do I translate this to the 4 hour chart? So I go to the 4 hour chart. I would need to mark where is the top of the daily bar today. So I'd need to go in and just go, yeah, it's something like that. And then go to the, just trying to kind of frame it properly. There we go. I must say NT5, I like it. I like it. So there we go. So tomorrow I'm then looking for a break above the high of that. Then I can start looking for moves to the upside. So when I zoom in, what I'm looking for, that'll be the top of the daily candle. I'm looking to see if price breaks through, and then I'm looking for it to come back and then carry on. So that might be my first entry, potentially my first entry. And what should happen, guys, is the 10 and 20 moving averages should start to do this, and the 50 will come under. So in other words, it should then start to pull back into that buy zone, giving me my first opportunities to the upside. But I'm telling you this because all based off the daily. So that's a potential setup long. So that's Aussie dollar, Kiwi dollar. Let's have a look at Kiwi dollar. Kiwi dollar is also setting up with a bit of a bullish candle here. It's got the same approach, and they're not the best setups. These are setups that are, they're okay, but they're not to me where I would sort of, they're on the bottom of my list of possible trades. Let's look at dollar CAD. Okay, let's go up to the daily. Not a very clear sense of what's going on here. So if you're not getting a clear sense of what's going on, just move on. You can come back to it, but just move on. Dollar yen. Okay, so dollar yen, we have a downtrend, guys. We have a downtrend. Boom, 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 boom. We've got price coming into an area. It's coming, the 10 and 20 are coming down. You know what I'd really like to see here is a red seller's candle. And there isn't one. So remember how I said to you, if you look at the daily, there's either a setup or there isn't. There isn't one here. But let's say that tomorrow night, there's a big red seller's candle. Then we've got a downtrend. We've got price coming back to a support resistance level. We've got a nice little bearish candle. Maybe we've got almost exactly the same setup we have here. Then I could place my sell order below that, my stop loss above it, and target the lows. So is that guaranteed to continue down? The chances are greater, but there's a great book called Thinking in Bets by Annie Duke, where she talks about the fact that when we say there's a 70% chance of that following through, there is, but there's also a 30% chance it's not. If you took that exact same trade setup 10 times in a row, 7 of those would go on and make money and 3 wouldn't. So just in case the one that you take ends up being a losing trade, doesn't mean it was a bad idea. It was a good idea. I'm trying to kind of give you a sense that this is repeatable stuff. Everything I'm showing you now is repeatable. So it's not quite there yet. What I'd be interested to see on the lower time frames is the 1 hour kind of up and then go into a downtrend by the end of tomorrow night, because that would be interesting to see that shift, and then that would result in a bearish candle on the daily. Otherwise, just wait until end of day. So dollar yen could be on my watches. So Aussie dollar to the upside, dollar yen to the downside tomorrow to have a look. And again, I could do the same thing. If we get a bearish candle there, I could go down to the lower time frame. Just have a line underneath tomorrow's daily candle if that ends up being a red candle, and then go down to the lower time frames and look for a break and a continuation down. That's really what we do as master traders. We see what the big picture is, and then we zoom in and we look for an entry on those same price levels. So dollar Swissy. Okay, dollar Swissy is a mess at the moment. It's a mess. No one's really trading it. It's just kind of doing its own thing. Okay, so I would maybe stay away from it for now. Euro GBP. Sorry, refresh. What? Where's my refresh option? There. Okay, so this is more bearish than bullish. Okay, it's heading down a bit. It's weird, it gapped down and pushed up. It's okay. Maybe come back to Euro GBP. Euro Aussie. Euro Aussie's just struggling. Bit of a downtrend at the moment. Yeah, not quite sure where it wants to go. Could be some good shorting opportunities there, but not ideal. And Euro Kiwi is going to be similar. It's also going to be looking nice and bearish. But look at this again. 1, 2, 3, 4, 5, 6, 7 days in a row. So if you go to the 1 hour, you've just got this. It's garbage. You can't trade that. So please understand that professional or experienced traders pick easier conditions, because trading is hard enough. Start with easy conditions and then just try and get as many winning trades as possible. Euro yen. Okay, again, I love this. For me, I'm looking for shorting opportunities here. I will keep an eye on this level for profit taking, but I'm looking for shorting bearish candles. So dollar yen, euro yen on my watch list. Should we just save time and have a look at all the yen pairs? Let's just quickly do that. Go look at all the yen pairs to see if it's the same idea. Pound yen. Okay, so pound yen is still within this range, hasn't broken through yet. Aussie yen, not really. It's a bearish candle. Could be a oof. Sorry. Okay. Wow. Okay. Refreshing. No. So nothing there. Kiwi yen. No. CAD yen. Yes, possibly. So CAD yen has also got a level here, but there could be a bearish continuation to the downside. And Swiss yen was looking good. I like Swiss yen. Swiss yen also trying to find some support here, so it is trying to get back up over that line. But I still think a bearish candle here could be a continuation. So that's Swiss yen, CAD yen, euro yen, and dollar yen have got some good potential setups on that. So we want euro Swissy, which is also, by the way, has broken through parity. So you look here's, let's call this parity. No, let's call this parity. Sorry, let's call this parity. There, that's parity. So that's interesting. So a euro to a Swiss franc is roughly 1-to-1 now. And yeah, it's continuing down, but it's starting to look a little bit more bullish. Let's go to euro CAD. Yeah, very bearish at the moment. It's also a bit overextended. So although it broke through, it's going sideways. Sideways like this and sideways like this are indications the market is pausing because it's running out of steam. Okay, so again, when it's range, the reason I say that is because then you have the same problem. You basically are going, okay, if you're going sideways now, I need to wait till you break down to carry on going short, or if you break up to become a buyer. Okay, so when it's going sideways, you need that. And again, although I'm doing this on the daily, guys, it's translating to the lower time frames. The safest bets will be when you've got a market, your daily is actively got days going down or days going up, and you can get in on the 15 minutes or 1 hour and ride that wave on a smaller wave. Pound Aussie. Okay, range bound. See the issue here. Some amazing trends, which we had last year? No, this year, holy cow, beginning of this year. And now we're just sideways. This is just a mess. And again, remember I said to you they're range bound. It's a lot of currency pairs are just ping-ponging around. So just, you know, if they're not trending like this, then they're not the ones. You can make all your money from 2 or 3 charts that are trending. And you lose a lot of money trying to engage in a market that, excuse my language, batshit crazy, that isn't there. So that's what I want you to take away from this, is that sometimes the market's saying, just stay away from me, I'm not in a mood to play. And other time it's like, okay, we're moving, are you coming with? Pound yen, we've seen pound Swissy. Pound Swissy is trying to head higher. Okay, so very quickly, there's a lot more green candles here, and it's produced a higher low. So it's gone from here to there within the range, and it's got bullish divergence. So both of these are trending higher. Again, from that low, so you've actually got a lower low, but it's going higher here. That's a very strong indication this is likely to head up. It hasn't got there yet, but is likely to break out. So I would wait, and again, you wait for the market to prove to you that it's doing stuff. So you wait for it to break out. You set an alert and you wait for it to break out. Pound CAD, this has been amazing. So it's doing a little bit more of a weekly retracement right now. So sometimes when you get a bit of a move on the daily, a move up like this, because we had the same thing, we've got that bullish divergence, bullish candles pushing up. If we get a bullish candle here tomorrow, then it could be a good continuation to the upside. So again, that's a tomorrow one, pound CAD. Aussie Kiwi is generally, look at the moving averages here, it's generally flowing up. It's just really choppy. So this is a chart where you can see which way the market is going, but it's really hard to get in because it's just gonna slice you. No matter what you do, it's gonna cut you. Okay. So just keep that in mind, but you can see which way it wants to go. It's generally trying to, so if you can find a smooth trend on the lower time frame, go for it. Aussie Yen is sideways at the moment, sort of ping-ponging from top to bottom. If you're asking me if we could trade something from the bottom of the range to the top, you can if the 1 hour and 15 minute are trending nicely. But generally like this, they're not. They're choppy as well, and then they're not ideal. Aussie Swissy is a mess. Stay away from that. Aussie CAD is trying to get higher as well. This could be good. So there's a definite level of support resistance there and a bullish candle, all right, and an uptrend. We pull back. So I like the idea of an entry above the high of that tomorrow. So that's Aussie CAD. That's great. Aussie CAD also looking good. Kiwi Yen, but choppy. Kiwi Swissy is range bound, same as Aussie Swissy. So in fact, same as Euro Swissy and Pound Swissy. So that tells you what's going on with the Swissy pairs. Kiwi CAD, is that it? No, it's also trying to climb higher. But it's interesting because it's smoother on the way down and choppy on the way up, meaning there's still not enough buyers. The way it works is once it breaks above here, more buyers come in, and then it smooths out because then it picks up momentum, and then you have more buyers than sellers. But in this point here, there's still sellers coming in and buyers trying to get in, and they're battling it out. So it's moving up, but it's very choppy. CAD Swissy. Range bound, again, it's a Swissy one. All the Swissies, look at all the Swissies just currently range bound. Okay, with Euro Swissy being the exception there. CAD Yen, we spoke about, Swissy Yen we spoke about, and I've got dollar, Singapore dollar here as well. And dollar, Singapore dollar is just swinging a bit wildly, but yeah. So I'm not seeing a lot of those that really look super, super amazing. I'm aware of the time. I'm gonna keep you about another 3 minutes and then we'll go. The indices are looking relatively bullish on those ones, so they are looking quite keen. There's a nice bullish candle, there's a nice uptrend, higher lows, higher highs. There's your 50, 20, and 10. There's your bullish candle. There's a bit of a level here, but that's a buy setup. So that means I wait until the market closes, put my entry above the high, stop loss below the low, and target a 3-to-1 or target the next level. Like that's it. But I always take profit at 1-to-1. I always take profit at 1-to-1, guys, because sometimes it would head up, but then non-farm payroll comes out or something on Friday, and then it disturbs the trend. So that looks good, which means the S&P 500 is also looking good. And again, they'll be good on the lower time frame. So you go to the 4-hour, you've now just got a nice consolidation breakout, which means there should be a pullback here and a carry on. Not even on the we've just broken out on the 4-hour, which means the 1-hour is now technically free. So now I've got my 10, 20, and 50, and a nice level of resistance. Price can now come back, produce a bullish candle, and take me off there. Entry above the high, stop loss below the low. I usually put 1 or 2 pips above and below. I include the spread in it. So there are trading opportunities on the indices as well to the upside. And we've got oil, which, as I said, is looking more bearish. It's coming down to a level. Otherwise, I would be like, get in there, guys, because this is nice. It's heavily bearish, but it's very move sideways and then drop. So it's very spiky. So that's why I'm not actually trading it at the moment, but I know which way it's going. You can see which way it wants to go. And we've got gold. Gold is again on a daily trend to the upside. It's producing a potential bullish candle here. A break above today's high tomorrow could be a signal up to these highs here. So that could provide, I beg your pardon, some opportunities. So how do we, one way to do it is entry above that high, stop loss here. Because if the market's going to head lower, it should go lower from here and it shouldn't trigger me into the trade. If it goes up, which takes a lot of energy just to go from here to here and break above those highs, it should carry on. I would probably even try and get some profit before that. Does that make sense? So that's a trade idea. The general flows to the upside. The market is kind of struggling a bit at the moment. So if it's going to go down from here, it should break the low, shouldn't trigger me in. But if it manages to recover between today and tomorrow and break the high, then that should be a sign that it wants to carry on up. And then I just take some profit before I get you and then maybe try and trade it up to these other levels. Okay, that was it. That was really what I wanted to show you because we were looking at currencies today and I've included the indices and commodities on that. So there was quite a bit. I think that there was quite a bit there. It was mainly waiting for the dollar-yen pairs tomorrow night. A lot of those yen crosses, the Aussie CAD pairs as well, Swissy yen, so yen crosses tomorrow, and looking at Aussie and Kiwi tomorrow if they break above the high, also with gold and the indices on moves to the upside. So there we go. Where's my slide deck? There it is. So I know we ran over, but I hope that it was okay that I brain dumped. Yeah, actually, just look, I am doing at least one webinar a week. So let me tell you now, just tell you which one I'm doing. I am usually once a week. Let me just show you tell you what I'm doing. So next week, I'm booked in. Let me just have a look. I'm trying to find it on my calendar. So next week, for example, yeah, but who is it? Oh yeah, no, so not Wednesday. I'm trying to see. I usually am doing at least one a week. Okay, I've got one Thursday. So there's one called Mastering the Art of Price Action, I think. Anyway, I should usually be doing one a week, if not every week. But thank you. Otherwise, what you do is you put it in the comment section when you fill out the feedback form, and I appreciate that, by the way. I really do. And I enjoy doing it. I really enjoy doing it. If there's stuff you want to ask me, just write it down between webinars and just bring it and ask, and just say, here's a question I had from between webinars. And I hope that you guys found this instructive. So we did look at the live markets. I showed you how I scan, how I know which charts to avoid, how I might, for example, get in on a chart that's not giving a very clear signal. The strategy approach, how I might do that, and yeah, and the concepts of support, resistance, and price action. That stuff's universal. So every trader worth their salt will know all that stuff. And that is it, ladies and gents. If you want a copy of this recording, do me a favor and just send it through to Adam. Just send me an email requesting it, and I'll send it to you tomorrow. Excuse me. just send an email through to tradewithprecision.com, adamant, and I will happily send you a copy of the recording tomorrow. And ladies and gents, thank you. I thoroughly enjoyed it. Enjoy your evening. It's still nice outside. I'm going to go walk the dogs now, and then I look forward to seeing you in future webinars. Thank you very, very much.